never going to have a tax increase. And what a nice thing to be able to say during a bond campaign. You get some stuff and you're not going to have to pay for it. Sounds pretty good. So I get it, and I understand why they've been attractive to a lot of people. There are also, as you know, and Jonah talked earlier about the caps that exist on assessed values in the current law. And if those are not right, then there ought to be a discussion about what those caps should be. And that's an ongoing discussion as well. Part of the state interest, because that gets asked, well, the state here is sort of involving itself in local affairs when they decide they want caps or not. Well, the state typically is picking up half of the debt issuance costs with these school bonds. So there is a state interest in what will be drawing on the general fund to finance matters of this sort. So that's kind of the CAM discussion. Maybe there's something specific you'd like to ask about it. And let me also mention Assemblymember Wagner's bill, because one of the practices that we've seen, unfortunately, actually memorialized in some contracts with some school districts, is a vendor saying, we will contribute to or help with your school bond campaign if we're guaranteed the business if it passes. That's probably a crime, but it's in writing. It happens. And it happens probably more informally than in ways that aren't as explicit as that. Those are the documents I've sent over to the Attorney General and suggested they take a look at them. And among other things, it may be committing public resources to the campaign indirectly, which is also against the law for the district to do. So I'm concerned, as I know some of you are, that this diminishes public trust in people responsible for the fisc in our local communities and state if we don't address these things. And to the extent that there is this active competition where there are some firms that say, we just don't want to do that. I mean, I've had underwriters say to me during the pendency of this debate, last month we turned down a deal that was a cap deal because it didn't make sense. The district didn't have to do it and they shouldn't have done it, and we told them that. And then they went and did the deal with somebody else. So we need to kind of set the ground rules so that they're good ones, that everybody can compete fairly with whatever those rules might be. And of course, what Jones indicated is 25-year issues, so that's being actively debated. No more than 4 times debt as the principal. Have them callable, that is, they can be refinanced if they're longer than 10 years. While I think it was mentioned, I'm responsible for a lot of the bond issues for the state of California that pay for not just schools and universities and college campuses and bridges and highways and levees and so on. But one of the things that we actively do is try to refinance old issues that were put out when the interest rates were substantially higher. And so I'm happy to report, because I just saw the summary this week, that in the last 2 years, refinancing bond issues, older bond issues, we saved California taxpayers $1 billion that otherwise would have been spent from general fund claims. So $1 billion saved by smart refinancing. It's a good thing to do, and we'll continue to look for those kind of opportunities. I should maybe also mention, because frequently people don't know exactly what the Treasurer does, is I manage a pooled money account. There's about $80 billion in it. It's short-term money. Local agencies use it as a bank. The state uses it as a bank to put money places where it'll be secure during their surplus times and draw on it when they need it. Well, the good news about that fund is that during the downturn, when lots of financial institutions were losing money, we actually made money during that time, and so there were hundreds of millions of dollars of interest earned just because it was very conservative, prudent investing, and we weren't buying offshore sieves or other sort of exotic derivatives and so on, but it sure mattered during the downturn to have that sort of conservative investment philosophy. I think I want to say just a word about state debt generally, because I think there's considerable misunderstanding and ideological commentary more than numbers-based commentary. I'm a banker. That's what I do for the state. And so one of the things I will often hear, and I'll see some columnists write a story saying, well, you know, we have a spending problem in California, not a revenue problem. And of course, whatever the amounts are in taxes, that's policy debate that people have to make a determination of how much spending is needed for essential services. At the state level, they're essentially education, health and welfare, and prisons. That's the budget, basically. That's it. Not much else. And it's interesting if you compare, let's say, from the time Ronald Reagan was governor. I was just starting to be a new assemblyman at the time Ronald Reagan was concluding his tenure as governor of California. State taxes were significantly higher then than they are today. So today, $5.39 of every $100 of personal income is the state income taxes. When Reagan was governor, it was $5.89 per 100 of income. So it shows you the sort of trend. There were a lot of cuts, as you know, during the last 4 years during the downturn. Nationally, the average cut in state and local budgets was 3.1% cuts. California state and local entities, 8.2%. So we actually cut more in California, about 2.5 times, what the national experience or average was in terms of budget tightening. And it does suggest that people took seriously that which Mike mentioned about me. I've been for 10 years saying, I'd like the old-fashioned kinds of budgets, please, where I can look at the revenue columns and match them up with the expenditure columns and know what we're spending for and why, and one column pays for the other column, and it's not, he called it unicorn sales. I used to call it fairy dust financing. It just didn't make any sense, and there was a decade, basically, of deficit spending and financing that was unsustainable, and I'm really glad that, though difficult, the legislature made a lot of necessary cuts. Voters did approve Prop 30 to have the temporary tax increases that makes the cuts not further and deeper, and the economy is picking up. So all of those things combined have made a real difference in terms of the accounts, but mostly the governor has been very disciplined about saying, I'm sorry, I want balanced budgets and we're going to do that. And so one of the measures of that is if you look at internal debt, what is the debt of the state of California now? There are pension liabilities in our accounts that are very substantial, that need to be talked about and figured out. The good thing about those long-term obligations is if you make modest changes in the structure, contribution levels of employees or employers, retirement ages, payout benefits, and so on, you can, over the long term, make substantial differences in the liabilities, and that's what they started to do or did a year and a half ago, and there's a continuing discussion about, especially with the teachers' retirement fund, how to address those unfunded liabilities. But if you're looking at the general fund debt, it's basically about $34 billion. And a lot of it is internal borrowing.